and financially assisting globally projects in the power sector, but also assisting financial institutions, agribusiness projects. I'm joined here this morning by a very relevant and interesting group of experts with expertise in commercial banking, DFI world, legal expertise. So I'm very much looking forward to the discussion of this morning on the topic. What I would like to ask our speakers to do is to introduce themselves and to make some opening remarks on the first question that I would like to pop out on the debt instruments that we currently have available and that we use. What are those instruments? Are they still applicable for the needs that we see currently in Africa and that the power projects need? Or do we need to adapt those financing instruments? And what is it that we need to be able to fully support the projects that we like to develop in Africa? Marcel, can I give you the floor first?
Yep, very good. Welcome, good morning, everyone. On behalf of Citi, very pleased to sponsor this debt financing session. For those not familiar with Citi or not that familiar, just as a quick background, Citi is the largest global bank in Africa, having been on the ground for more than 50 years. We operate in 40 countries in Africa and having an on-the-ground presence in 16 countries, including key markets like Nigeria, Ghana, Kenya, Tanzania, South Africa. Over the past 2 years, we've enabled over $1.5 billion in funding for projects in the power sector in Africa. And in addition to working very closely with our corporate and public sector clients in the power sector, we're also one of the leading arranging and structuring project finance infrastructure risk for the international capital markets globally. My name is Marcel Hanen. I'm based in London. I'm responsible for the corporate banking business as industry head for power and utilities in EMEA. Obviously, Africa is a key area for ourselves, one, because of the strength of the footprint that we have, but also for the whole Power Africa initiative. I think there was a lot of momentum currently in Africa. I've seen more deal flow, I think, over the last 12, 18 months than what I've seen in the past 3-4 years. And as a US bank with a US nexus, we see a key role for ourselves. I guess a couple of key comments that I wanted to make regarding debt financing. A lot of the sessions have spent time on the demand for electricity, the electricity rates, the latent demand, I think, and the cost of electricity provision. I think if you look at what is required, there are many studies around Africa, and I just refer to one of them that is from McKinsey that came out most recently. And they estimate that the region would need about 840 billion of financing up to 2040, both in generation as well as in distribution and transmission, which is an immense amount. I think with that in mind, all available sources of financing need to be mobilized, I think, to support development in Africa, whether that's commercial banking, whether that's DFIs, whether that's ECAs, whether that's development money, whether that comes from Europe, US, China, Japan. I think the challenge is so big that whatever source of financing Africa can find, we need to utilize. At the same time, I'm saying the availability of financing is not a bottleneck at this point. It's really the availability of bankable projects. I think the situation in the international markets is very, very favorable for Africa. There's a lot of equity available. I've spoken to a number of equity funds, fund managers, and I've never seen that much interest for investing in power projects in Africa. At the same time, I also believe that from a debt financing perspective, there's a lot of appetite from banks, from institutions to provide debt financing as long as we get to a bankable project. For me, how do we get to bankable projects? It requires an integrated approach of restructuring public utilities, incentivize private sector participation, and as I mentioned, attract every available source of financing to support the development of the power sector in Africa. Finally, I think one of the key things that we need to focus on also is development of a domestic capital market and enable access to the international capital markets. To a large extent, projects rely on commercial bank financing and more so on ECA and DFI financing. I think government should really also focus on enabling projects to get access to the international debt capital markets, because the pool of money available there, again, is significant. There's a lot of appetite. There's a lot of hunt for yield in the current interest rate environment. So I think that should be clearly on the agenda of the governments, in addition, I think, to all the other priorities they have to make sure that we can get the power sector developed and new projects developed. And I'll stop there.
Elvira,
Thank you.
Sorry to interrupt. Could I just while Marcel mentioned it,
Sure.
one of the key things I think there, sorry, Martin Kavanagh, I'll introduce myself when, actually, do you mind if I do it now?
No, you can do it.
Martin Kavanagh, I'm a partner at the law firm Herbert Smith Freehills, specialising in project finance, particularly in sub-Saharan Africa. One of the key things I think that comes out of what Marcel mentioned is repetition and track record in terms of attracting these additional resources, and in many cases the track record that will attract additional debt and additional investors and in fact help put together the better projects. It might come from outside the electricity industry, it might come from outside power, it might even come from outside project finance, but any jurisdiction where investors and debt providers are able to see a steady track record of government behaviour immediately provides a benefit, and certainly then within the IPP sector, and we see this a lot, sometimes we advise governments as well as investors and lenders, is seeing that track record and the constancy of delivery, if you like, without hiccups. And I think that's sort of, I just wanted to interrupt because Marcel sort of made that point in 4 or 5 different ways in the points he was making. So, right.
Thank you. Thank you for that. Thank you. Roland, can I turn the floor to you?
Yes, I'm Roland Janssens. I'm Deputy Managing Director at Frontier Markets Fund Managers, which is part of Harriet, that manages the Emerging Africa Infrastructure Fund, and we're a significant investor in power projects in sub-Saharan Africa. I largely agree with the points that have already been made by my 2 colleagues. I will just slightly put it in a slightly different perspective or look at the timeline. There is, in the short term, despite that 840 billion number, in the short term there is, I think, no shortage of either equity or debt capital available, and probably the syndicated loan markets could handle that. What the issue is sufficient bankable projects that in turn the availability of those projects is predicated on, in the first instance as most important, what you said, a predictable cash flow, which means a predictable regulatory environment, regular tariff increases and so on, so that the industry can carry its costs. A contributing factor that has been talked about recently and which is important, but we won't go into it here, is you will need more standardization of documents because it is a very expensive process as long as it remains relatively bespoke, to take a lot of time to develop and a lot of costs to develop these projects. If you then step back, the other factor is how many power plants can you bring online, because they ultimately depend on the growth of the economy. There is a cycle. You need the power to grow the economy, but you also need the economy to grow to justify the power plants. We are generally, let's say, cautiously or slightly better than cautiously optimistic on this whole cycle. If you look at the 840 billion number you quoted, I would say medium to long term, you will, I think, see the need for first corporate bonds for utilities or groups that have multiple power plants or distribution networks or whatever that may be. And inevitably, sort of long-term, my thinking is 10 years, something like that, you will need to see an increase in project bonds. The question then is, what are the features of those project bonds to attract bond investors? And then there may be all types of tweaks that need to be made, and we can maybe go into that and talk about that later. In the short term, there is a question is whether there are tweaks that can be done to improve the process for syndicated loans. So I will leave it at that with comments on this.
Okay, thank you, Roland. Thijs, may I ask you to take the floor and maybe also respond to Roland's remarks on the future for project bonds and what the features are that are needed to convince the institutional investors also to play their part?
Thanks, yeah. Again, I think I agree with the colleagues, the comments. So my name is Tiens Ellis. I run the project finance business for Barclays Africa. Barclays has been very active on the African continent, presence in 13 countries, in some of these markets for more than 100 years. And as a bank, we realized the need for the continent to have a safe, secure supply of power. So it's a big focus for the bank and specifically for the team that I run as well. As far as the markets are concerned, debt instruments, we've actually had quite a detailed look at the capital market appetite to go and invest in these sort of project bonds. And it's interesting discussions. If you speak to some of these pension funds, you will find a lot of them have sort of two teams, a team that will directly go and invest in debt alongside banks, and they actually prefer to take normal debt instruments, quite happy to participate on exactly the same terms as the banks, take very long-dated paper, and they will typically go and park these instruments in a specific portfolio. If you talk to the same institution, maybe just the guys who look at the bond side of things, you will find that it's not exactly the same story. And these guys typically have sort of three big problems at the moment in investing in specifically power project finance bonds. The first issue that comes up is that they're not all comfortable with taking completion construction risk. It's something that we as commercial banks are very used to taking. We know how to evaluate, but I think the sort of skills to do that is not currently at that level where they're fully comfortable taking that. The second issue that comes up is they're not all comfortable taking sort of 18 to 20 year paper. Even though from a loan side they may be quite fine to take an 18-year loan, from a capital market instrument perspective, I think there are different rules and different regulations that will apply to capital market instruments also as to how they need to go about valuing these instruments, mark-to-market issues, which means that the very long-dated nature of these instruments for some of these players is an issue. The third issue that came up in our discussions with a lot of these guys is they need a market where they can go and trade these instruments. Now, at the moment, in South Africa, there's one project bond out there for one of our renewable deals, and that's really the only example of a project finance bond in the power sector. So I think it's up to the financial institutions, probably collectively, to create a platform and a market where these instruments, once they become once there's more of them out there in the market where they can actually trade these instruments. So in a way, I think between the commercial banks, between even assistance from the DFIs, that liquidity and that market platform will have to be created where these instruments can be traded. But ultimately, from a pure banking perspective, to be sitting with 18, 20-year debt on our balance sheets with Basel III and all other regulations is probably going to become tougher. And the more natural home for a lot of these instruments is actually in the capital markets. It's got to go to the pension fund industry. It's got to go to places where they sit with very long-dated liabilities. And we've been actively looking at developing those markets and those conversations with these players, not only in South Africa, but I think the same goes for the rest of the continent. You know, there are many players out there that have these long-dated liabilities that would want these type of assets, but the markets have to be developed, and that ultimately is a natural home for a lot of these debt instruments. I think I'll stop there.
Yep.
Thanks.
Thank you, James. Tas, may I ask you to introduce yourself and also to follow up on the issues that were mentioned, a lack of bankable projects. I heard it now many times. What are initiatives like Africa 50? What can they do to bridge that gap, to make them bankable, and also to address the commercial investors' appetite and to tie them into the project as well?
Sure. Thank you, Elvira, and good morning, everyone. I am Tas Enverapur. I used to manage private sector infrastructure finance business of African Development Bank. I think the bank was quite successful in the last 6 years in terms of investing in private infrastructure projects in Africa. We invested in 49 of them, and we put $3 billion from our resources, and we syndicated another $4.6 billion. But when you look at the bottom line, actually, as the African Development Bank, through those projects, we facilitated $32 billion worth of projects in the infrastructure sector. It's a good track record, but it was an incredible learning experience for the bank as well. As such, we were able to look at where we went wrong, where the projects are going wrong, what is happening in the market. Yes, we facilitated $32 billion, but when we look at what is needed, as my colleague from Citibank mentioned the numbers, I think still the significant gap is continuing. So us delivering all those projects and facilitating $32 billion is not really helping the market. That's why we had to look at our model, and we had to analyze what we did and what needs to be done. So therefore, we came with an idea of creating a new vehicle. Obviously, when you create a new vehicle, you don't have to report and repeat exactly what you have done in the past. So it has to be something new. It has to be something innovative. When we were looking at all the projects in the continent and why they are not really progressing, one of the issue came to our attention was governments, most of the time, they are not able to properly offer those projects to the private sectors to increase the private sector investments in those projects. Actually, the issue in the market is not financing. Issue in the market is lack of bankable projects. Let's say that one government has 3 priority energy projects, and each of them are 500 million. Actually, prepare those projects and offer the private sector, there is a need for upfront investments. In Africa, unfortunately, this is a very high number. It is almost 10% of the total project cost. If you have 3 priority projects, each one is like 500 million, then you need 150 million to bring those projects to a certain level and offer to the private sector. Most of the time, we all know that this type of budget doesn't exist. And why the private sector is not coming to this area? Normally, they should be basically investing in this area as venture capital. Most of the time, when you look at all the projects delivered in the continent, actually one project to reach financial close is 7 to 10 years. The longer time you spend, the project development capital you will need is going to be higher. So therefore, people are not very comfortable to come and invest in this area as private companies. Number one, they are not 100% sure when they are going to get this risky capital they invested back, if they are going to get it back, if the project is going to reach the financial close. So first of all, we decided to create a project development company, which will be taking a commercial approach, because project development is actually a very commercial activity. Once you reach the financial close, you can take your commercial capital back, but also the premium. So therefore, the first activity of the Africa 50 will be creating bankable projects along with the governments and financing that early project development capital on a cost-sharing basis with the governments. Once the projects are reaching financial close, both Africa 50 and the governments, they will take their capital back plus the premium, and they will go and develop more projects. As such, continuously, actually, the number of projects coming to the market as a bankable projects will be increasing. Obviously, when we look at also the project finance side, I would like to give you an example. I'm sure most of you in the room, you know about Lake Turkana project. It was an incredible learning experience for us. 7 years project development, finally reached financial close, but we learned something during this project. If you would like to take the project to financial close very quickly, you should be able to provide different products to make sure project is going to reach the financial close. Later, you can spin off and sell them down in the market. But to be able to bring that 7 to 10 years to 3 to 4 years and decrease the project development capital, you have to be able to offer all the products needed. In Lake Turkana, we were in the development capital side. In Lake Turkana, we provided mezzanine, we provided senior debt, and we also provided PRG. Today, if we have done all of them at the beginning, that project would have reached the financial close 3 to 4 years, not in 7 years. So therefore, the project finance component of Africa 50 is designed in a way can offer wide range of projects. Wide range of products, starting with bridge debt, bridge equity, to make sure that close the gap and reach the financial close quickly, and then spin off them in the market, sell them down in the market. Then classic mezzanine, classic senior debt, but the most innovative one is, today we know that commercial banks, they would like to invest in the market, but one of the biggest problems they have is they cannot do more than 7 or 8 years of tenor. Africa 50 can guarantee to buy back their loan at the end of the tenor. So as such, Africa 50 doesn't have to use its own money, but provides guarantees actually for the commercial banks. And then 7 years later, when we buy back those loans, we can basically go and issue bond in the market against those projects, or we can package and sell them to the institutional investors, and continuously we can recycle our capital, but also we can bring more capital. Africa 50 is established with the sufficient capital actually. The project development company will be starting its operations around $200 million, and $200 million will be matched with from the governments or other parties. As such, it's going to be almost like $500 million. And think about continuously you are recycling with the premiums, it will be growing and it will be producing more projects and more opportunities for everyone. And project finance company is established today with $1 billion, and this is the public side of the capital. Because we believe that it is very important when you go to the market, you say that all the African governments are part of Africa 50 and political commitment is there. This is the public side of the capital. It is public-private partnership. Africa 50 targets to reach 3 billion with another 2 billion from the institutional investors. And then targets a single A rating. With the single A rating, it will be increasing its capital base in the capital markets almost to 2 or 3 times to 10 billion. We believe that Africa 50 is one of the solutions, but I think with the new model, it is going to bring quite a bit vibrance into the market.
Thank you, Tas. Very inspiring story from Africa 50, what it can do to promote more development in project development.
Elvira, can I just say one thought? First in country deals or landmark deals like Turkana are very difficult to do, everybody knows that. Quite a few years ago, I was Lender's Counsel on the Bujagali project in Uganda, which I worked on for about 4 years, although I've seen various people wandering around the hallways here who worked on it for much longer than that. I'm currently doing a hydropower finance in Uganda, in many cases quite similar to Bujagali. We're probably going to reach financial close in about 9 months. Points that we discussed with the government for a year on Bujagali, we've dealt with in a week on this deal. And I think the key thing, every time you do a first-in-country deal, it is going to be difficult, it's going to be complicated. Even with the best people in the room, it's still going to take time. What I think is really important is making sure that everybody is really well advised at that first stage. At the moment we're advising, it's a different continent of course, we're advising in Nepal, their government on their large export hydro projects. Same thing, the first deal we negotiated took probably 2.5 years with GMR and so on. But again, having the right advice, the right people in the room and so on can make a large difference. It's still going to take a long time the first time you do something large in country, and the later deals will be much easier. but it is very, very important to make sure that people are properly advised on risk.
Yeah.
Just one other thing I wanted to mention. I do quite a lot of work in the oil and gas area as well, and Ernst & Young publish a regular report on attractiveness of investment, and Africa has raced up the rankings as an attractive investment environment in oil and gas. 4 years ago it was ranked 10th out of 10 regions, and now it's ranked second only to North America. Now, this is not a risk analysis, it's an attractiveness of investment, so it takes return into account. And of course we all know you can, in many cases, sell oil and gas abroad, so you're not necessarily taking domestic offtake risk. But these, in many cases, well, in all cases, the countries that are now ranked the second most attractive investment environment in oil and gas are exactly the same countries where we're talking about investing in IPPs on this panel. And the same governments have passed regulations and laws. They put in place bodies to deal with development and so on. Now, no one's suggesting it's perfect by any means in oil and gas, in fact, far from it, but there's clearly an ability and a willingness in that market, and the ability to finance and investment in that market has raced ahead in the last few years. And all of the things we're talking about, we're not talking about a lack of investment or debt, we're talking about a lack of good projects, and if the projects can be made better, I think exactly as everybody else on the panel said, the money will flow quite easily after that.
Yeah. Thank you, Martin. Thijs, can I ask you to also reflect on the story from Tras on the arrangements that are now being developed also for the commercial banks to be more active in the projects, and what are the type of arrangements that you would be looking for commercial investors to have more appetite to participate for tenors that are maybe a bit longer that are now on the table?
Yeah, sorry. I think what I would like to share is, to make these things bankable. You talked about the first deal is always difficult. I think you've probably sat through a few other panels and listened to the story from South Africa around how they've gone about procuring their renewable energy program. And I think there's quite a few lessons there for me. I mean, it was also, in a sense, the first time we were doing real RPPs in South Africa. So in a way, you would have expected the first deals to take very, very long. But in reality, the first round of deals got closed within 12 months. And I think there's some very good lessons, and I think the way, and this is really a good story from South Africa, the way they've gone about doing the procurement and doing the homework up front was actually laying the foundation for the entire program. Mm-hmm. And what they did quite well, I mean, they've basically set up a specialized team to run the program on behalf of a number of government organizations. Yeah. And you can imagine there's so many role players, interested parties within one government. On our side, you have ESCOM, you've got NERSA who sets the tariff, you've got the Department of Energy. So to bring all of those on the same page and get them to work and drive in the same direction is quite an effort. So this team basically coordinated all of those efforts. But what they did very well up front when it comes to laying the foundation is actually consulted widely with the banks, with the EPC contractors, with the guys who do the O&M, and with the sort of IPP investor community. And consulted with them in terms of what are those issues that will make the deals bankable for them? What is it going to take to get them over the line to go and invest in this program? And from the banking side also, what do we need as banks to make sure that all these arrangements are bankable? So up front, those critical inputs, and also they've appointed very good advisors to assist them on the legal side and technical side to make sure that we are looking at international best practice. But by the time the actual procurement happened, the deals were imminently bankable. Mm-hmm. So the PPA was fine. The government support structure, behind ESCOM's obligations were fine, and we spent no time having to negotiate those documents. So we could focus on the real important stuff, which was, let's make sure the financial model works. We've got a sound EPC contract, O&M contract, and everything else was basically fine. And the other thing to go with that is sort of laying out the long-term vision and plans for, it's not only 1,000 megawatts of projects. Actually, we want to get to like 20% of the country's capacity. And from an investor perspective, and even from a bank perspective, that gives a lot of confidence that it's not a once-off thing. This is actually a proper long-term program. So, which basically entices investors to go and invest in things like manufacturing facilities in countries, so that more of the equipment can actually be manufactured locally. And I think that goes a long way to instill quite a lot of confidence. And eventually, and if you follow the program and see what's actually happened, it resulted in a massive reduction in tariffs. I mean, in cases, 50 to 60% reduction across wind and solar, and ultimately achieving the objective, which is providing cheaper electricity to the people. So on the debt financing side, sorry, just to conclude on that, for the banks and financial institutions who actually provided debt financing to the program, we were able to do and to provide quite competitive terms. And the terms got even more competitive as the program progressed, and everything got more competitive. And that was also achieving exactly what the government wanted, which was all of these things: EPC prices reducing, O&M costs reducing, and bank terms getting more flexible, and all of these basically driving lower tariffs. To the extent that we can now generate cheaper power from both wind and solar than from coal or other sources.
I would agree with you that the South African program was very well organized. It standardized a lot of things. It went beyond the documentation. It really looked at everything, contractors, the whole thing. Underlying that, though, there were three more factors, I think. It gave visibility on how much power was going to be bought from what type of sources and so on. So you had a view on the industry and so on. That was a degree of predictability. More importantly, though, while it introduced an element of competition, it did set maximum tariffs by differentiated source of power, whether that was wind or solar and type of solar and so on. And so that added to the predictability regime, because ultimately, for money to flow, to make electricity flow, you need that tariff that makes everything compute for the financiers. And in this case, it did. The problem in a lot of other African countries, with maybe somewhat of an exception for Kenya, is that predictability is still being established. It's coming, but it's not quite there yet. So either the cash flow cascade system in the industry as who gets paid with what priority, or the track record of the regulator approving the right tariff increases given inflation to reflect the cost of the electricity produced, is still not quite there. Okay? And that is a key factor if you want to get to this sort of system. That drives everything.
Yeah. No, I would like to add, it's also, say, the standardization is really important, but it's also providing the clarity for all the investors to say, what is the government focused on? What are the government's priority? In too many cases, we see that governments don't prioritize well and have too many potential power developments on their agenda. So it becomes very unclear, I guess, for the developers, but also for everybody around it, including the banks, what is the priority, which projects should we really focus on? And when there are too many around, then too many will fail too.
Thank you. I would like to turn the floor to the audience and take some questions for our speakers. Who can I give the floor? There's a mic on its way. Any questions that we can take? In the meantime, Tas, can you reflect on the comments that were made?
I think that's for the sleep.
Yeah. Let me try again. Tas, can you comment on what was mentioned? So it is obvious that the South Africa program was successful, and the features that were mentioned drove that success. It was a very predictable framework. It was very strongly driven by the government. They were very clear on what they wanted. And it gave a lot of confidence for all investors involved. But obviously we see that not a lot of other countries are in a position yet to copy that, and they have different country circumstances. So what is the advice that you would give to the other to countries in which you have been operating and where Africa 50 want to be active? What is it that they should do to employ more of private sector activity?
Actually, I think the landscape in Africa is changing. I can see that in a number of countries, direction, they are basically trying to go and replicate something similar to the South Africa model is already happening. I think Egypt is already going to that direction. Kenya is contemplating that. Nigeria already started. Progress is slow, but we know that things are happening in Nigeria now. But for the other countries, unfortunately, things are still working on the deal-by-deal basis. One of the reasons, actually, when we created Africa 50, we focused on the project development was actually helping those countries to bring those projects to a certain level so they can basically invite other parties. I can give you an example, not from the energy sector, because Africa 50's first project development pilot project was actually in transport sector, because it was requested by 3 governments. Africa 50 will be mostly focusing on transformational, regional, and national projects. This was one of them, and it was very well fit. So what we did was actually we worked with Kenya, Uganda, and Rwanda governments on a 2,000 kilometers railway, which is a very complicated project. There are many components, and for each component, there are different levels of studies are completed. And the total project cost is 15 billion, and in Africa, we all believe that large projects cannot happen. So it was an incredible commitment from the government side, and the project was led by 3 presidents. That made a big difference, because when the commitment is there, and when the political commitment is there, projects can move very fast. So in 6 months' time, Africa 50 was able to prepare a bankable business plan for this very complicated project. So it was kind of like creating the capacity at the government side by using one team. Who was this one team? The team was Africa 50, and advisors. We brought the best advisors from all over the world together, and also the 3 teams from 3 governments, but not from the line ministries. Our counterpart was actually Minister of Finance, who holds the money. So then they were coordinating with other ministries, line ministries. But it became something very interesting, because the project suddenly became not only a railway project, but it's kind of like an integrated project. And power component was added, and the mining component, and who will be the users, who will be the financiers. So the business plan right now, what offers is actually the first phase of the project development is done by the government in line with the best practices, and second phase, actually, the governments are going to invest the private sector to bring the development capital. I am sure it will be much more easier because the most risky part is already done. So coming back to your question, I think in those countries where things are done deal-by-deal basis, type of institutions like Africa 50 will be very useful. I just would like to make a statement here. Africa 50 is not a development finance institution. It is set up as a corporation, and it follows the rules and regulations of any private company. And it can scale up its capital continuously to support project development and project finance, and it doesn't actually tie its resources for a very long time to any loan or any project. I think one of the area altogether we have to talk here, and I am opening a new topic towards the end of the conversation, how the development finance institutions will restructure themselves to meet and cope the market's need. Because development finance institutions, normally, when they provide a loan, 15 years, 18 years, they basically stay there. They never recycle their capital. I mean, one of the reasons we created Africa 50, because when you are a development finance institution, basically you are dependent on your donors to increase your capital. And today, with the complication of economic development and economic structure in those countries, actually, you are not able to increase your capital as much as you would like to increase. So therefore, I think this has to be also discussed and then rethought.
Thank you, Ahola. I think it naturally flows to you, and I will come back to you.
Yeah,
Yeah.
Well, I was going to comment on both what Taz said and on what you said earlier, because there is one other aspect of this South African program, and it ties into what Taz is saying, that to the extent that countries are working on an organized program where you can really do a lot of deals. The documentation is all, it's clear what the sector is. The capital markets in a number of other African countries are not quite that developed. So you would have a problem suddenly raising that flood of money. I don't think the DFIs by themselves, because of exposure limits, if you then really started to do that, or even the commercial banks could cope. So to the extent that, say, a Nigeria or a Ghana or an Egypt and so on succeed in this, there is an additional huge financial job to be done, and say elements like Africa 50 are clearly anticipating this. We also have a Garantco fund that can help sort of prolong, for instance, guarantees for, say, if people want to take 5-year bonds, that they can take them at the end. But there is a lot more work that needs to be done to sort of jumpstart and handle that, because the South African capital markets are much more sophisticated and developed than those in other countries. So this is an important point, I think.
True. Yeah, I was just going to say, when one of the themes that's running through is talking about how we release that long-term debt and allow development institutions to go back to the front end of the projects and so on. So we've talked about capital markets, we've talked about financial investors, Canadian pension funds, insurance companies and so on, who already invest in, project bonds is one, it's a little bit challenging because of the interface of a project, a bond, a set of bondholders with a bank group from a technical side, and that will continue to be quite difficult, I think. The only way those projects will succeed is where there's likely to be very little disruption to the project during the period of the bond, because the inability of bondholders to react and respond to situations that arise. But if we're thinking about financial investors and what attracts them, and they already invest in infrastructure and energy projects in many, many markets, it's not by any means too difficult to think that they could be interested in investing in many of the markets that we're talking about. South Africa obviously is already there in some respect. But what they're looking for is certainty and stability. And even if some countries for the time being will be beyond their realm of acceptable political risk, I think many countries have the possibility of being within that, but the starting point has to be that the government agrees, at least in the documentation that surrounds the project, to protect the project from changing government policy, from political whim and all of these type of situations. At least if we can start with the basis of the project being to protect the project from unreasonable disruption, even during the execution phase, put aside the construction phase, then at least investors of the type that many of the other panellists have mentioned, and mezzanine investors, for example, and other financial investors, they can at least get their head around the idea that someone's got the right intentions at the time they put the documents together. And you can then think about backing up that obligation with guarantees, with support and so on. And there's a lot more places where that's available from now.
I think you are absolutely right, but we also have to look at the development finance model, because today there is enough capital interested in coming into Africa. So how we can make their life easier? Maybe we should think about more like guarantee products, like completion risk guarantee or construction guarantees, and maybe even increasing the PRGs and PRIs. And as such, we cover the more like guarantee side and let the regular and then classic capital to come to the market and do both debt and equity. Because I was talking to so many parties when we were doing the fundraising of Africa 50, but previously also with all the institutions around the world, similar to South Africa model. When we were designing Africa 50, we went to everyone. We went to all large companies from GE to GDF, Suez, to everyone. And we asked them, if we set up a vehicle, what would you like to see in that vehicle? We did the same thing with the commercial banks. We did the same thing with other development finance institutions. So everyone was basically saying that we are ready to come to Africa, and we are all devising our investment plans for Africa, but we need guarantees. So I think construction risk guarantees or completion guarantees, and maybe even first loss guarantees, we should be looking at the new products to bring to the market.
Okay.
I remember that during my Singapore trip last year, I talked to the Singapore government. Singapore government set up an institution called Clifford Capital. The role of Clifford Capital is basically accompanying any Singaporean investor who's coming to Africa. So why not creating this type of more institutions?
Thank you, Tess. Maybe I can comment on this point myself, being a representative from a DFI. I think I fully relate to your point that we need to reconsider financing models and whether the classical project finance model still holds. Surely it still is valid for many reasons, but I think we also need to constantly rethink what we're doing. And within FMO, we also have started up an initiative. It's a fund that we hope to have up and running early next year to address a lot of obstacles that we now see to get projects on our plates, because we have been up until now been very active in providing senior debt or mezzanine financing to projects that have gone through their early stage high risk phase, have done their feasibility studies. But what we've seen is that we want to be more active in that early stage to make them more bankable and to partner up with developers in an early stage. So what the fund will do is to be active in that early stage with developers, take up half of the development costs that are needed to get the project to that first critical phase. Then when it enters the construction phase, the fund will take up 3/4 of total project costs fully with equity. So it avoids a phase of numerous negotiations, agreements with lenders, and you have a more of an equal relationship between the sponsor and the fund, both providing equity to a project and guiding it through the construction phase. And after 2 or 3 years, the fund will then bring the project to its third facility. It's called the refinancing facility, where commercial investors are funding this facility and can then take over the project at lower cost as the project have been de-risked from the construction phase into the operating assets. So by launching this fund, we hope to address some of the bottlenecks that we see right now. Not a lot of the really purely development cost equity available, then guiding projects quicker through that construction phase, avoiding lengthy processes and negotiations with all kind of debt providers across the table, but also unlocking commercial funds and investors to be active in the power industry. Are there questions in the audience for our speakers? Yes, there's a lady here in the front. Can the microphone come up? Is there a microphone available?
Yeah, it's coming.
It's behind you.
Good morning, everyone, and thank you for this enlightening discussion. And hopefully, we will see ourselves moving into this new phase. I just wanted to ask Neside, did I get your name correctly? I'm very excited about Africa 50. I heard about it recently, and great to hear what you are trying to do. And I want to talk about sovereign guarantees and ask about sovereign guarantees, because it seems like a lot of investors still want sovereign guarantees. Mm-hmm. Now, you've spoken about other alternatives, which, well, could be a bit more expensive, but I'm liking the idea that we're moving away. I hope we are moving away from sovereign guarantees, because looking at Nigeria as a case, government doesn't have much money. All prices have gone down. So all the projects that are going to be going on stream in the next few years, you would most likely not be getting any sovereign guarantees. So I wanted conversation around what other kind of government support you'd want to see, you know, including some of the sweeteners that you're talking about.
Well, I think recently we start to hear this a lot. Government guarantees should not be there. But I think we have to note one thing. We are still in the interim transition period in Africa for all infrastructure projects, not only for power projects. And we've been talking about this just before we came to here when we were discussing how we are going to handle this panel. If you like to attract really very good companies who are going to be there with you for the next 25 years, during this transition period, you have no other choice but provide those guarantees. I can give you the examples from my own country, Turkey, and also I work in India in the energy sector for many years. You have to cross this bridge, and you have to provide these guarantees to IPPs for them to actually feel comfortable and come to your country and basically invest in your country. Today, both India and Turkey actually power is pure commercial trade. I mean, there's no power purchase agreements in Turkey anymore. But we had to go through this stage. you cannot jump that stage and then start straightforward that, the commercial trade for power. So you will have to still consider these guarantees. But obviously there are other products available, such as, anyway, I think Roland wants to jump in.
He's very eager to jump in.
Yes, it's very simple. You should ask yourself the question, why do people ask for a sovereign guarantee? And the reason is bankability.
Yes.
And the grounds for that sovereign guarantee is usually twofold. There is predictability of behavior on so-called political risks. Say the government decides you build your beautiful IPP and then I'm going to nationalize it, or some other thing happens. And the other one is an element of commercial risk, because somehow you build your IPP and the utility to which you supply doesn't pay its bill, and it doesn't pay its bill because it turns out consumers don't pay their bill, actually, including the government, for instance. And then you say, well, why would I as an investor take that risk? And because the government then is, for understandable reasons, because politically we want tariffs low, people want power, but they also want it at a lower price. So they say, we have elections coming up, let's not raise the tariff and all that. So, without a guarantee then, you know as an investor that you do not have that predictable cash flow. And therefore, people say, well, that's great, but then we want to be sure that you're going to pump in some money if it goes wrong. So guess what? We ask for a guarantee. Where is that guarantee not asked? For instance, take the example of Kenya. KPLC has a very long track record. Okay, the Kenyan government may still give a letter of comfort on certain things, but there is predictability, so people are comfortable. They say, okay, I don't need a government guarantee here because we know how the system works and people respect it. Voila. Same thing in South Africa, obviously predictable system.
Yeah. Just one comment to highlight. I think what you mentioned is cost-reflective tariffs. And that's the fundamental of every sustainable power sector in every country. And in many countries, tariffs are not cost-reflective, and that creates just a lot of fundamental issues, which at the end come down to the fact that investors feel uncomfortable because costs are not reflected, and they need to have support directly or indirectly from the government. So I think the starting point really is for every government to restructure its power sector to make sure that tariffs are applied on a cost-effective basis. And I understand the political rationale, but at the end, there's no way around it that consumers have to pay the price for their electricity. And I do think many governments underestimate the willingness and the ability of people to actually pay for their electricity. There's so many hidden costs in the system with backup generators, heavy fuel oil, diesel generators. The electricity price that is currently being charged, I think does not reflect half the true cost, because there's so much hidden cost in the system that is not there. So starting point to me is really cost-reflective tariffs, and that over the medium term will result in everything falling in its place.
Just to add that you touch a very important topic. I think willingness to pay is always underestimated everywhere in the world, because no energy, not having electricity is more expensive than anything else. Yeah. But coming back to your point, obviously, one of the biggest problems today because of this guarantee is basically the government's debt capacity is pressed. So this is something we start discussions as Africa 50 with IMF. So what we are trying to convince IMF about is actually real debt and the guarantees are two different things. So you cannot really consider guarantees as real debt. So you have to basically at least discount the guarantees so you can give people some room to play so they can still provide these guarantees in this transition period. We are hopeful that we will be achieving that in one country. If we can achieve that in one country in Africa, it means that we can basically replicate it everywhere else. I think this is something very important in this transition period. But the whole thing is making IMF understand that guarantees are not debt. Yes, there is a possibility that guarantee will be called, but it's a very low possibility. Today, if you even look at MIGA, how many MIGA projects are in Africa? Many. How many of them were called for default?
None.
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 I can tell you this, none. So I think the risk perception needs to be changed, and we were discussing about this actually yesterday in a different context. Moody's did a research all over the world. They looked at 4,500 project finance transactions in infrastructure, and 138 of them were in Africa. The default rate, the lowest, was in Africa. Only one project defaulted. And it is also actually proven with our portfolio. We did 49 of them, and there is no loss, knock to wood. So therefore, I think this needs to be discussed a little bit further between the sovereigns and IMF, and also institutions like African Development Bank and Africa 50.
Another question, yes.
I'm from Nigeria, and infrastructure finance, development finance in the Central Bank of Nigeria. My comments are these, and I would like to react to that. I'm from Nigeria. I'm in Saudi Arabia, somewhere in the UAE. I go to the restaurants. I look at the names they have there. I can't recognize anything on the menu. And yet, I'll ask them to bring something for me. It runs my belly. And, Madam, are you leaving? Actually,
she has to go to another meeting, so if you can just make it very fast that you can still answer.
I'm preparing the ground to hit you hard. So please. Okay, if you say I should just summarize, I want to hit you hard straight and probably below the belt. I think you are giving Africa too much of something, a pre-prepared format they must follow. You should be able to calm down, study what is on ground, and then tailor whatever you have to what can work. That means you may have to adopt an out-of-the-box approach. Project development is one of the major hindrances to getting bankable projects in Africa. You cannot tell an African government to encourage or guarantee project development because most of the government terms are short. In Nigeria, for example, it's just 4 years, another government is coming. 2 years into that government, they are thinking of what have I achieved. Project development phase takes a very long time, even beyond 4 years. And no government will want to stick to that. So what have we done as Central Bank of Nigeria? Recently, we sat down, we paid some consultants, and came up with an infrastructure finance policy. And one of the things we talked about was how do we develop a project development fund that should be able to take care of some of these things. We want to be able to move away from country guarantee and so on. How do we do it? We should be able to bring along some of these private developers, let them see the potentials in that particular investment that is to be done, make it bankable, and then sell it out and let it work. In Nigeria, for example, I could say we virtually don't have a mass transit system, and yet there is a lot of money that could be gotten from rails in Lagos, in Port Harcourt, even in Abuja. No mass transit system. And there's money sitting there begging for people. We clapped for MTN. They came in, they looked at the environment, and then they put something that will work today. MTN is ripping a lot of money away. There are such development opportunities, and you cannot hang them to sovereign guarantee. So I'm saying we should increase encouragement of central banks in developing countries like Africa to put out some form of guarantee or some form of project development fund, and these can be done through policy development in African countries. Let's think out of the box and not continue to impose what you already have and is working in your country, in another country. It will only run their belly, just like it does to me when I come here and eat whatever I find. Thank you very much.
Can I?
Maybe I give Tess the last word because she needs to leave. Out-of-the-box thinking, Tess.
Well, I think Africa 50 is already out of box thinking. what you could do is, actually, I give you the example how we did the railway project with 3 governments. And believe me, when we started, I remember I gave this as an example in a conference in London in August, last August. And one of my fellow panelists said that we should forget about this kind of projects. When you talk about 15 billion, it will never happen in Africa. And I told him that, of course, if we start, it will never happen, but we are starting, it will happen. All right? So I think your thinking is really quite advanced. This fund is going to be very useful for Nigeria. And, but what we could do is we can partner with the project development side of Africa 50, like we did in Kenya, Uganda, and Rwanda. Because 3 governments, they put 2 million each, and we put 2 million. So we co-develop the project. So once we reach the financial close, we will take our 2 million, 3 governments, they will take their 2 millions, and with the premium, they will go and do more projects. So I think there is a good opportunity for us to work together. And obviously, you know, the government guarantee is still needed in some of the projects. But mostly we are talking about the energy projects. In transport side, it's a little bit different story. Like we did Dakar Toll Road as African Development Bank, and we don't have any traffic guarantees in Dakar Toll Road. So it means that each project is unique. You have to structure in a very unique way. What you were saying, actually, you have to think out of box for each project, and you have to really structure in a special way. That's what we've been doing in the last 5-6 years, actually. That's why we decided to create Africa 50, something very different, and it's not another development finance institution, but it is something, it is a commercial project delivery and commercial finance institution, so it can continue to scale up its capital and continue to serve the market.
I'd maybe say something more controversial. You know, over the last few days, there are so many private sector developers out there in Africa. I don't think we have a lack of good developers. I also would go as far as saying I don't think there's a lack of funding for these developers. I think there's a bottleneck, though, in actually getting these deals awarded projects and getting them to close. Because, again, just maybe, and apologies for using the SA example again, but the guys are willing to spend the money developing the projects because they know there's a high certainty that they will actually have a successful project at the end of it. So in Africa, the need for development is absolutely enormous. But if the guys know that they will actually be able to develop a project and they will actually get the deal to close, I don't think there's going to be any shortage of funding, even private sector money, to do the development.
Agreed.
It's getting the deals over that hurdle and getting them to close. That's the problem. We sit with 1,000 projects out there, and I can tell you there's no shortage of debt funding. There's no shortage of equity investors looking to invest in the projects. There's a shortage of good projects.
I think I will never make my next meeting, but I would like to be even more controversial. I agree with you. There are a lot of developers. I've been talking all of them in the last 3 days, and I've been talking them actually in the last 12 months. Yeah. So they always come to you with a portfolio of projects. Madam, I have 15 projects. Madam, I have 12 projects. Madam, I have 6 projects. You look at each of them, they are very good projects. Yes, it's true, equity is available. Yes, it's true, debt is available. But that project development capital is still very limited because people, they don't want to take the risk. When I look at these teams, they are holding this good portfolio of projects. They have every single quality to deliver those projects. But nobody wants to take that risk called venture capital for infrastructure. So this is what actually we are trying to address through Africa 50, and I'm very happy to hear what the central bank created in Nigeria. This is an innovation, because once you put these things together, so we can bring certain things on the table, experience, track record, and then how we deliver those 49 projects. Believe me, except 2, all of them were painful. Out of that 49, only 2 went to financial close in 2 months' time. The rest, they were all very painful. We did a lot of restructuring. We spent a lot of time. So therefore, I think it is very important to really understand that we have to find a way, encourage people to bring capital into this space. This is very important. Because today, if we have 500 million project development fund I mean, it's different than Africa 50 because Africa 50 will be co-developing projects with the governments. They are transformational, they are regional, they are very specific. But if we have another 500 somewhere, we can give 20, 30 million to these developers. We will see incredible speed of delivery of projects in Africa. Having said that, thank you. I have to leave now.
Thank you. Well, I think that's a very good conclusion and assignment for all of us that hopefully next year, same time, same place here, we can talk about more about what these new initiatives and framework has brought to the African continent and more projects being developed. Thank you so much for your questions and the speakers for this morning's discussion, and talk to you later.